And this is the Coins, Cashflow, and Conversations podcast, sponsored by Upstate Essential Solutions. If you need help with accounting, taxes, or personal finances, contact me today, Dakota Grady at dakotagrady.com. Hey y'all, welcome to the podcast. I want to come on today, talk about what is a HELOC, a home equity line of credit. All right. I had a client ask me recently about that, and she was basically saying she should get a HELOC. And I didn't respond to her in terms of actually the question, but I'm going to answer it here. So let's dive right into it. So, what is a HELOC? A HELOC is simply a home equity line of credit. Now, how do you get a HELOC? So, if you own a home and you have equity in your home, equity means basically the current value of what you have for your home minus the amount you owe for your home. So, for example, if you have a home worth $150,000 and the balance due on that is 100K. So your equity built up in your home is 50K, which is the amount you paid off, right? Now, you can access that money in two ways. You can get a home equity loan, which is basically a lump sum of money from your home, right? Or you can get a home equity line of credit, HELOC. And that's basically similar to a credit card. It's a revolving amount, so you take it out as you need it. Now, you have equity in your home, what you built up in it, what you paid off basically so far on your mortgage, and you're going to borrow against that equity. So the 50K I mentioned earlier that you have built up in equity, you want to take it out either a lump sum or take it out in increments, like a credit card, right? Now, when you do that HELOC, if you do a home equity line, you can get a low interest rate. And essentially, it's a second loan on your home, a second mortgage on your home. You get a second mortgage on your home, and you get a low interest rate. It's fixed. So it's just like you're getting another mortgage, but it's a second mortgage. It doesn't come prior to the first mortgage. The first mortgage has precedence over second mortgage. So the creditors on the first loan they will get that money before second creditors do on the second loan. All right. So taking that money out, and my client wanted to do some repairs on the home, I believe, or a rebuild, I believe. So you can use that money as you would like, and maybe you want to do some repairs on your home, maybe take a vacation, pay off some student loan debt, or maybe you want to just pay your kids college. Right? There's different things you do with the money, right? However, that collateral basically is your home, meaning what you're putting up for collateral when you first bought the home, it was basically the mortgage. So, in other words, if you default on that loan, basically the lender has a right to put a lien on it and sell it if you don't pay on it. So the question begs, should you get a home equity line of credit or a home equity loan, right? Well, I don't want to be the bad guy always saying no, but I'm a no debt guy. I don't like debt. Talk about debt on a different show, but I recommend not getting a home equity loan. And here's why, or here's why. You're putting your life at risk, meaning your home at risk, livelihood. You have a family, maybe you're married, maybe you're single, but the whole point is place that you rest your head at night, the place that you give yourself peace, place that you give yourself stability is more at risk now because you have two loans on your home. If you get a home equity line, a home equity loan, or if you get the home equity loan on the credit or HELOC, you're still putting your home at risk. Whether you're taking out a large lump sum or you're taking out incremental amounts like a credit card and paying it off. The whole point is you're putting yourself more at risk. That's what debt does. Debt puts you at risk. Now, the other downside is well, I guess upside, again, you do things that you wouldn't necessarily have the money to do because you take money out that you've already earned by paying the debt off, right? So you taking money out, getting a fixed rate that's lower probably in or southern market, or maybe even close to what the market rates are, opposed to paying a high interest rate going somewhere else to a credit union or another bank, right? Or even a credit card. You're getting a lower rate for that equity, getting it through your home. The other downside is if the market basically crashes, or if the market goes lower, say the value of a house initially I said it was worth what, 150, right? Well, you paid it down to $100,000, right? That's the mortgage that you owe, the amount you owe in your mortgage. But what if you owe 100,000, right, on the loan, but your house is only worth 80,000? Ooh, that means you're underwater. In other words, you're upside down, meaning the value of your home that you basically is worth $80,000, right? But you owe $100,000. The difference is 20K. That means if you were to sell your home at fair market value of $80,000, you would take that money and pay off the loan. However, you wouldn't pay it off because you would only bring $80,000 to the table. That means you got to go borrow an additional $20,000 to make it a difference because, again, you're underwater. So in that case, if you got a second mortgage on your home, you probably have to pay more because the first mortgage is $100,000, but you take out, say, $50,000 again when you use the original amount. So you got to pay back the $50,000 plus $20,000. So you're going to basically end up being the whole $70K. $20,000 that the house didn't bring when you sold it, plus the amount you owe on the mortgage when you take out the second mortgage, that home equity line of credit, right? So that's the thing. You're putting yourself at risk because you can't control the market. You only can control what you can control: your mind, your thoughts, your words, and your actions. You can't control the value of home prices at all. But what you can control is whether you take out the HELOC or the home equity line, right? Home equity loan. So it's up to you to decide. I've given you something to think about, and you have to make a decision. Is a home equity line of credit, HELOC, or a home equity loan, is that a good thing for you and your family? You decide. I'm giving you information. You make a decision. I don't think it's a good decision for anyone because it pushes you more risk at being in debt, and you could possibly default on a loan. Things happen. People lose jobs. Businesses slow down. So you don't have control of those things. You only control what you can control. You can control how much activity you create in terms of earning income, but you earn a lot of income. But if you continue to borrow money, like digging a hole and trying to get out of it at the same time. Right. So again, I want to give you something to think about when it comes to a HELOC. Hope this was informational and educational for you and informative. Please like, share, comment, subscribe to the Coins, Cashflow, and Conversations podcast. I'm doing this for the next 90 days, just bringing value to you, hopefully to add more to your knowledge about personal finances and business as well. And if you need help with accounting and taxes, contact me today, dakotagrady.com. To find out more about me, dakotagrady.com is a website, and also got a freebie for you, something of value. If you want to save money on your taxes and your business, I have some strategies for you for a free value, freebie, for you, tool, resource, if you want to call it, at my website at dakotagrady.com. Click on where it says the tax solutions. There's a link right there for you to get a resource for you to help you save money with tax strategies. Again, this episode of the Coins, Cashflow, and Conversations podcast is sponsored by Upstate Essential Solutions. Contact me today, Dakota Grady at dakotagrady.com.